Hi guys, welcome back. Frankly Finance, I'm Gemma. This is Lexi, and today we're actually doing a part two because last week we started talking about investing in property within Australia, and as most people will be aware, there's just so much to it. There's so many pros, so many cons, and different nuances that people need to know about. So we ran over time last week. So this is part two, and in today's episode, we're going to focus mainly on the disadvantages, because when we were reflecting as we finished the half hour, we had kind of only talked about really positive things about it. And of course, with anything, there's pros and cons. So today is not negging on investing in property, it's just part two. So if you're just catching us on this one, we really recommend that you go back on the Finito platform. It's the past recording, so go check that one out as well and look at all the other stuff that we talked about around that strategy. But yes, definitely part two of this is going to be focusing on more so the issues in property investing.
Where do we even start with this one? What's first on your list?
Okay, well, actually, to make it a little bit interesting, because I also had facts last time that we didn't go through, and I know you love it. So let me start with some stats. And of course, people just put questions in the chat if anything comes up as well. But so there are 2.6 million investor-owned properties in Australia. Oh, how much do you think they're worth? $1 trillion.
Yeah.
In trillion. What do you reckon?
A lot. I have no idea. My mind can't even comprehend like how many zeros are in a trillion.
Out of those $2.6 million investor-owned properties in Australia, they are worth approximately $1.37 trillion. Pretty crazy. So investor-owned properties make up 27% of all properties in Australia. Do you think that's higher than what you would thought?
That is one of the stats that I looked at about 12 months ago now, and it did surprise me a little bit, but now that I'm hearing it again, it doesn't. And I would suspect that that number changes over time, like pre-COVID, post-COVID, those numbers would be a little bit different as well.
Yeah, I did actually see, was it in the news this week, that the amount of investor-owned properties is dropping because of the holding costs and interest rates and all of that kind of stuff. So that will, I think we'll actually see that going down. It's getting harder to get into the market, and it's being harder for people to hold on and manage the outgoings with it. So yeah, we'll probably see that drop, I would expect. But 70% of all property investors have a single property. So they have one investment property in their overall portfolio. They might still have a primary residence, but only 4% of those investors have more than 4 properties.
So when you see on news.com.au that the electrician has 28 investment properties, he is
and he's
not the norm. Yeah, he's not the norm.
Yeah, I always see those ones. Yeah, we've got 100 properties in 90 days. Like, yeah, cool. Yeah, no, he's definitely not the norm. So only 4% of investors have more than 4 investment properties. So this probably won't surprise you, but the highest income earners, so the top 20% in Australia, are more likely to have an investment property. Yeah, pretty common. And this one also didn't surprise me. So the majority of investors that have an investment property are aged 50 or over.
That surprises me a little bit.
Oh, you reckon? Why?
I would have thought that it would be potentially a little bit younger and I guess tapering off in people approaching retirement because you can't sell a bedroom.
Yes, which is on my issues list. But yeah, I think it's when I was financial advising for retirees, it was usually pretty common that they were looking to get rid of their investment properties in the year or after they retired, strategically for capital gains, for tax reduction. But yeah, usually they don't want to have all of those types of problems in retirement, like, because investment properties aren't that passive. Like, you actually have to do things for, you have to do maintenance. Like, I've had to lay turf in the rain. Like, you can outsource it, but there's still quite a bit that you actually have to do, and people get sick of that when they're older.
You did just make a really, really good point that I picked up on because I'm familiar with it, but anyone else listening might not have caught on. You just spoke about being a little bit strategic on the timing of selling an investment property in the year that you retire. Do you want to delve into that a little bit more before we move forward?
Yes, absolutely. Oh, my last point is
Mm.
only 14% of investment owners are between 30 and 39. So
14.
our age.
Yeah.
So yeah, 14% of all. That's probably still
Which
pretty
is
high.
also a lot of people who have young children. So depending on ages of children, maybe on one income, if we've got one parent at home. So that probably plays into that quite heavily as well.
Yeah. And last week we did talk about if people strategically are buying an investment property or they're just being an accidental investor because they've moved on to their next house. They've moved on from their starter home to their next one. So that might be a bit too. But yes, let's get into strategy. And this is absolutely not financial advice. It's factual information about why people have done things in the past, but it's so important that you get advice when you're looking at selling a property because there are so many knock-on implications that we'll touch on as well. But so really strategically, because when you sell a property that's not your primary residence, so when you sell your house that you've been living in and you've always lived in, it's generally capital gains tax-free, right?
Yeah.
So you don't have to pay tax on the profit that you've made on that property if it's been your primary residence. Whereas if you have it as an investment, it's kind of like if you've just had shares or managed funds or any other type of investment. If it's grown in value from what you've paid, you will pay tax on that difference. So if you've held the property for over 12 months, just like if you held shares for over 12 months, you'll get a discount of 50%. So say you bought it for 500 and you sold it for 700, very simple maths. Instead of having that 200,000 profit that you have to calculate tax on, you'll only have to calculate it on 100. Automatically 50% is discounted.
Mm-hmm.
Yep.
And that gets added to your taxable income.
Yes. Yep. So any money that you've earned in that year, dividends from shares, interest in your bank, salary, income from work, any of that, that profit gets added on. So people often think, and this is a misconception that I think we've spoken about in a different episode, people often think there's a different tax rate for investment income and gains on properties. And usually they think it's 50%, but I think they're getting mixed up with there's a discount and those things. But yeah, any of your income that you earn in Australia, it's all on a marginal tax rate. It's going to be added to your marginal tax rate as if you earned it from work. And that's what the tiered tax that you're going to pay. So what people do is if you're wanting to limit your tax, there's lots of ways you can do it. But one way with property is to strategically sell that property in a year that you're not working. Perhaps you're taking a year off to travel or starting a business and you know you won't have a lot of income. You're on maternity leave. Or in a lot of the cases that we just referred to, people are getting sick of having property. They want life in retirement to be easier. So perhaps they'll look at selling it the year after they retire. So the year that they don't earn any income from employment. So their tax is right down and then that gain can go towards that.
While you made a point of saying it's really important that you get advice when you sell, it's also equally as important that you get advice when you buy, because you can't suddenly change whose name the property is in when you go to sell depending on the situation. So it may be a case whereby we do have one parent on parental leave in the year that you're wanting to sell, but the property might have only been in one person's name and that person might be the person that's working. So if you have thought ahead, you might have been able to either have it in joint names or that other person's name, but then that ties into something else that you'd want to be talking to an accountant about in relation to the deductions that you can get with owning a property and whose name they are more appropriate in. So it becomes a little bit messy, but it doesn't mean that you can't work it out. And sometimes you just have to make a decision on what you do know.
And that comes back to what we were talking about, which I think we always refer to, is before you buy something, have a plan on what it means to you. So even if it's your first home, think about long-term, realistically, will this be an investment property? Because that's going to change whose name it's potentially in. Or will this be something we sell to buy? Will this be our forever home, or is it a stepping stone home? Like if you think big picture, long-term, as much as you can, things change, but it will mean that you can strategically structure things. Because yes, if you unless it's a separation, a divorce, you want to transfer it to somebody else's name, you're going to pay stamp duty and all the fees that go with it, unless it's like a family separation courts kind of thing. So yeah, as early as possible, you want to think that, because if it's going to be a family home, then fine, it's totally fine in two names. If it's going to be an investment property that you want to be tax effective and the cash flow to be tax effective and help like negatively gear, then it's generally better in the higher income earner's name. But if it's a property you want to say flip, you want to make money, or add value to it and then sell it within a few years, then it's probably better in the person that earns less income and doesn't work at all. So these are the things that you want to talk to an advisor and an accountant about, and try to plan as far ahead as possible, going, what does this property mean to us? What is our goal with buying it? Because then you can structure it a bit better.
And one of the downsides that we were going to talk about today ties into the timing of selling as well. So it may be a case whereby you've decided you don't want your investment property anymore. You've got kids that are in childcare, they're going to school maybe next year. You could look at the differences as well between selling now and the impacts that might have on your childcare subsidy, or selling next year when you don't have childcare subsidy issues. So there can be, for some families, a really big difference. It might be the difference between receiving a childcare subsidy for that whole year or not receiving it. So they're things that you might actually sell the property, not really be thinking about these things, and then be hit with a big bill from Centrelink yourself that you didn't think about these things, and wait, could have been one more month and fall into the next financial year, for example.
Yes. Yeah. All right. So on my list of the disadvantages of property, okay, so diversification is the big one, and I think I touched on this last time. Like the chances of, we only hear good stories about property. Nobody really talks about the bad ones where they lost money, think mining towns and stuff. But the chances, you need to put all your eggs in picking the right house on the right street in the right suburb in the right state. That's pretty risky. Whereas share portfolio, you can have a basket of things. Whereas, we talked about 4% of people that invest in property have more than 4 properties. And I would imagine they're diversified on different streets and different suburbs and things. Whereas the majority of people have one, and they're putting all their hopes and dreams on that property doing well. So that's pretty risky, right? It's a single asset in a single asset class in a single area. So that's probably my main issue with investment properties. Whereas if you have money, and especially when people have a self-managed super fund and they buy a property in that, and then they've got a residential property and they might have an investment property outside, I'm like, all your assets are now in Australian, usually residential property. That's so risky. Whereas if you had an investment property and your house, but you still had super in lots of shares, at least you're still diversified. But people that just love property don't look at it like that. So yeah, I think that's really important.
I find that a lot of people in the discussions that I have are really comfortable with property because they're familiar with it. They've got friends that have property. They've maybe got a property themselves in their residential home. They can touch it. It's not anything that is scary potentially. Whereas alternatives to property, for example, shares, maybe they don't know anyone that has had shares. Maybe they don't really understand, like, what is a dividend? How do I make money with shares? Is it like gambling? Like, can I just lose all my money? So yeah, that ties in with what you're saying there.
And if you think about like the barbecue chat, people will always talk about how well they did out of a property or whatever, but it's rarely people will say how well their shares have done. Usually it's like, oh, the share market, I lost all my money in super. And I tend to hear like the negatives around shares, but then property people just absolutely love, or they keep quiet about it if they don't. But yeah, absolutely generalizing. Yeah. So the other thing that we touched on before is the exit strategy with property. So if you're investing in property and you need money, it's not a liquid asset. Like, you can't sell a bathroom or a bedroom. Yes, there's ways to tap into your equity, but it's using banks and lending and stuff. But like a share portfolio or a different type of asset, you can sell down a little bit. Whereas this, you really can't. You're kind of like all in or you're all out, right? And even when you do decide to get rid of that asset, it might be on the market for a really long time. You don't know how quickly things are going to sell, and it's expensive. You've got real estate agents, advertising, capital gains like we talked about. So you really need to think about what your strategy is around this, and if you're holding it long term, and do you have other assets that you can access and tap into if you need them, rather than having all your money in that.
And that becomes more and more relevant in retirement. So if you imagine a couple in retirement who have a $500,000 investment property and they decide that they want to go and spend 50 grand on a trip to Europe, trip of a lifetime, if they don't have any other funds, they have to sell the entire property and pay all those fees that you just mentioned to get their 50 grand, because they can't necessarily go, there are reverse mortgages and things like that, but putting that aside, they have to sell the entire thing. They can't, as we joke about, you can't sell a bedroom. Whereas if they had a $500,000 investment portfolio in other things, shares and managed funds, then you can just sell $50,000 worth and keep your other $450,000. So yeah, that becomes more and more relevant closer and closer and in retirement, but it's still something to think about no matter what age you are.
Yeah, so we talked about like 30 to 39-year-olds, 14% having investment properties. I tend to see that a lot of people, the younger people that have investment properties, will tend to be asset rich but cash poor. So they have these assets that they can't touch into, and it's great because they're building wealth, but cash flow wise and access to money for holidays and stuff, it's all tied up in the equity in the property that they really can't tap into. So this is really common when you hear people talk about they're asset rich but cash poor. Yeah, is because you can't sell a bathroom to tap into, or a bedroom. So two other main issues is the tenants, right? So if you're an investment property, you're hoping that the property will grow in value or that the income that you get from it, they're your two strategies. And sometimes you do, can have great income and it can cover all of its expenses and even provide you some additional, but you want it to grow in value as well. So there's that capital gain. But there are so many horror stories, if you've ever watched Current Affair, on terrible, terrible tenants, right? The damage that they can do, not paying rent, how hard it is to get them out, how rules just are more and more in favor of tenants. So that is something to consider as well. Having a good tenant is crucial to making your life easier when you are investing in property.
And I think we've got someone with first-hand knowledge potentially in the chat talking about that. Maria's put the comment, there is also the risk of having a good investment property but bad tenants. So yeah, I have had a lot of conversations with people who have had that experience. Also as well, you see, particularly in Facebook groups at the moment, people not wanting to necessarily put the rent up of their investment property because they feel bad doing it. And so that can also cause issues. So you spoke about investment properties not necessarily being passive. So yes, there's the laying the turf in the rain, but also there's the sleepless nights feeling like maybe you're not doing the right thing by the person because you're having to put their rent up because your mortgage repayments have just gone up so dramatically.
Yeah, and there's a social and ethical side of it as well. Like I know lots of people are very much against people being able to have investment properties and that type of thing. And I have investment properties, and so I'm obviously all for it, but I can totally understand that moral obligation. And to be honest, like my real estate contacts me every probably 6 months and be like, all right, we should put the rent up like $10, $20, $30. And I'm like, no, because like I know at some point we will, but I'm like, I've had these amazing tenants that have my personal number that will text me and be like, oh, hey, the lawn's not looking great. We love doing lawns and whatever. Can we go to Bunnings and get this stuff? And they're just like all about it. So yeah, I think having a tenant, like a really good tenant, is worth everything. And every time you actually need to get a new tenant, there's quite a lot of fees involved. So relisting, doing the contracts, all of that kind of stuff, I think it costs me, and it'll be different for every real estate, but I think it costs like about $1,000 in fees and stuff every time I get a tenant move over. So I'm like, why would I increase it by $10 or $20 a week just to risk getting tenant I don't know and then paying all that? So I'm just But yes, so that having good tenants is really, really important. That ethical dilemma, yeah. And then the biggest one I would say is the cash flow, right? So lots of people assume that if you have an investment property, the rent should cover the mortgage, the rates, and all of the outgoings for it. And yes, they sometimes do. And yeah, there absolutely are properties out there that do that. And depending on, how long you've had it, it might come to a point where it does. But in a lot of cases, there's actually, you have to be contributing to the outgoings of it.
The last one that I looked at for a client, they were having to put in 10 grand a year on top of the rent was 10 grand short to cover everything, which can definitely make an impact on whether you want to keep that investment or not.
Because that can put a strain on your everyday cash. Like I kind of, at the moment, I don't have to put in any on mine, but that will change with interest rates. But I kind of think it depends on your strategy. If I had to contribute a little bit into it, I wouldn't be too concerned because I'd be like, oh, well, that's just kind of like if I was investing into an investment portfolio or whatever. It's not like it's dead money. It's so that I can retain the asset and it will hopefully grow. So I'm comfortable with that, but I'd only be comfortable if I actually had that money, right? If that was, if I didn't have enough to cover that, one of the first things that would have to go would be one of the properties, because it's more important that I put food on the table and can pay, my house expenses. So yeah, it's one of those things that you can have the best intentions with the strategy, but it might actually change. When you bought your investment property or your home that you live in, you might have been on 2% rates, and now that they're on 6 and 7, it might not be an option that you actually retain them. So.
And whilst it's not much of an issue in many places in Australia at the moment, but vacancy risk is something else, which if you don't have a tenant for even just 1 week, 2 weeks, that obviously eats into the annual income that you're getting from that property. So just something else to be mindful of more than anything, which maybe you have to offer a lower rent, but then that kind of continues on for a longer period.
Yeah, and I think like even if there's like a low vacancy rate in the area, there's usually a crossover period, right? It's like so even if you're getting a tenant in straight away because there's high demand, there might be a couple of weeks of downtime between yours leaving and the other one starting. Like I know lots of places are in a position where there's hundreds of people looking at rentals going, we'll pay 6 months in advance, we'll pay more rent. But sometimes there's going to be that downtime. So if you are going to be an investment property owner, you need to have your other fundamental financial stuff in place, like an emergency fund, like a buffer in your loans and things, that if there is downtime or all the expenses come at once, you've got to do repairs and things, you need to have access to money to be able to fund the expenses that go with that. Like in a share portfolio, you're not going to get a knock on the door from CBA and go, hey, our bathroom's broken, can you chip in, you're a shareholder. But no, you get an investment property and they're like, oh, you're up for a new water heater, $1,500, now you're up for this. So you need to have a buffer in that.
So I guess in summary from last week and this week, it is that no one should go out and buy an investment property just because they think it's the next thing that they need to do. And no one should go out and buy an investment property because they think it's this magic answer to getting the tax down. And no one should go out and buy an investment property because they think that it's going to mean they'll be getting more income in the door. It's going to be a case-by-case basis, and you need to lean on the support around you. And I'd say that's predominantly going to be an accountant in a lot of instances, because a lot of people buy investment properties for the tax benefits, but then also the capital gains planning as well. And it may also be a financial advisor. I see a lot of people who are making super contributions in the same year that they sell a property as well, being a little bit strategic there around the tax. So yeah, it's not to say that investment properties are bad. You have one now, I have had one in the past, but yeah, just don't listen at the barbecue, do your own research.
Yes, I 100% agree. And they're absolutely not for everybody. And lots of people, you talk to and they go, I just don't want the hassle of it. And it is a hassle. Like it rarely goes smoothly. Even if you've got a real estate agent dealing with it, you have to be present and be aware of what's happening. You can't outsource all the responsibility of it. But yeah, I think as long as you're diversifying, if investment properties are for you, I'd really encourage you to make sure you have other assets, whether that's your super and that's in a share portfolio or something like that. But if you've got a residential property that you live in and then you've got an investment property and that's it, you're not diversified. You've got a high risk in Australian residential property, so you need to diversify. Even if you don't love shares or don't love property, there's different assets that can make up things that'll help you tax wise and it'll help you build your wealth. But yeah, crunching your numbers first and not buying off I would love to live here in an emotional state, putting the investor hat on and doing all the numbers first and getting an accountant to help you is really, really important.
And this isn't so much in relation to property, but tying in with your comment just there about not loving shares. So pros and cons to shares as well. But a lot of people, especially the younger demographic, don't pay a lot of attention to their super because they feel like they can't access it at the moment anyway. So yeah, if you pay more attention to that, you will notice that you are invested in shares, managed funds. And that ties in as well to a comment I heard yesterday where people were talking about how disgusting it was that the big supermarkets are putting up all the prices and everything. But part of that conversation did not include the fact that those billions of dollars of profit that are being made are benefiting them as well because they are investors. So whilst that doesn't mean that that should happen for that reason, I think it's just important to look at the whole picture rather than just a little part of it.
That's my argument when the banks release their profits and people just uproar. I'm like, I bet most of you in your super funds are investing in banks and would, like, my other point is I'd be super worried if the banks weren't making profits. They're like some of the biggest companies in, like, we want a strong economy. We want businesses to be making profits. And yes, the flow and effect is to most people's superannuation if nothing else. So yeah.
So they're getting upset about the profits, but then they're getting upset that their returns aren't what they want them to be because the profits won't be there.
Yeah. And I think, and they also don't put into context that those profits compared to the amount of assets and like things at the bank and the amount of people that they employ and all of that kind of stuff. I'm like, yes, that would be a big profit if I just generated it myself.
Happy days.
It's just like a massive corporation that owns, like, they own all these assets as well, right? It's not just your bank fees, your $8 a month or whatever. That's not what made the profit. What made the profit is their investments and the buildings that they own and this and this. Anyway, that's a topic.
We always seem to get right into it and really excited at 11:28.
And then we go, we need to talk about that another time.
Yeah. So I don't know what we're going to talk about next week, but we will be same time, same place anyway.
Okay, perfect. And we'll put this in the recordings. But yeah, just remembering, if you're watching this one, you should definitely watch part 1 first, which was the previous weeks, because today was just all really the negatives.
Yeah.
Cool. We will see you next week.
Bye.